Right, hello and welcome to Advanced Bookkeeping, Level 3, and we're going to do the practice assessments today. So I've got a BPP Practice Assessment 4 set up from the 2016 syllabus book. So what are you going to see today? Well, you're going to see a practice assessment undertaken in real time. So apart from just general revision, this is going to sort of really help with sort of exam technique really, and so you can see how we're going to go about it. So what we're going to see is we're going to see a lot more workings today. So you're going to see about at least 10 pages worth of workings, which is how the exam should be undertaken. So in your exam you should see a lot more workings in there. And why do I go about doing it like this? Well, firstly, the exam is quite computer based, so it quite lacks sort of accessibility of sort of scrolling up and down really. So this approach is going to overcome that kind of idea where normally you have a nice paper-based version. You could put highlighters and mark it up and put some notes next to it. This approach with using the workings is really going to fix that. It's going to also as well check the work. Now you'll see quite often your tutors will say check your work. That doesn't mean redo the questions. What this means is it's going to sort of, the approach that we're going to take is actually going to fire out quite often whether our answer is right or wrong. It will also as well fix little errors. You'll see in the upcoming video that I make a few errors occasionally, and then the workings and the way in which the technique's going about it will come back in and correct that quite quickly. And also as well counters the stress, makes it a lot less stressful. A little bit stressful this assessment there because I've got to get it all right, 100% right. So, but you'll see as we're going through, it just simply turns it all into a very much quite nice and orderly approach. In terms of time, what I think you'll see is it might take actually a bit longer than the average student for the first run through, but it will be 100% correct first time. Probably if we're doing this approach in the exam, and it's a 2-hour exam, we probably take about an hour and 15 minutes, something like that, maybe a little bit less, but we could, you know, that's before any kind of checking, whatever. If you were struggling on particular questions, then we start to add on some more time. So if you're going out of the exam and you're completing it in less than an hour, let's say, you'll see that this approach will take a little bit longer, much better in terms of the way in which we're going to go about it. What you will see though is there's a lot of things where you'll see the actual answer being worked out and being correct for the thing, right? And also as well, as you'll sort of see, technique-based method. We undertake a technique, and all for each of the questions, and the answer drops out. So it's going to be a lot more accurate, that approach really, and it's going to be a lot less stressful. So that's what we're going to see coming up. It's going to be quite rough in terms of, because I'm actually doing this and just looking at the assessment straight away, and not really sort of going through and polishing this at all in there. But that's quite useful because you'll see occasionally whereas I'll flick through a little error that might appear in there, but then will be very quickly corrected with this kind of approach. Okay, right, so task 1. So this task is about non-current assets. Better word for non-current assets is fixed assets. So these are assets that are going to be used by the business over the long term. So we've got things like computers and furniture and cars and what have you, land and buildings, that kind of thing. Tangible fixed assets in particular is what we're going to have. AAT likes to call them non-current assets. The rest of the world calls them fixed assets. So you're working on the accounting records of business stores Markham. Ignore VAT. All right, so you see here I've got my piece of paper really in here, just on screen so you can see it, but no VAT. Let's just get hold of there though. I quite like this approach because it takes the stress out of it when you're talking away through it. So no VAT, and we've got a purchase invoice received. Okay, right. So we've got some things here. So we're looking through now. We're going to sort of see some items here. So we've got an office suite and we've got some delivery charges. Now we're going to really start looking for the capitalization note, really. Are we going to capitalize this or not? But that looks quite reasonably big, so probably are going to. Now here's a little trick. Delivery and assembly charges here. So anything that is required to get the asset in situ, in place in there though and start to be used is something that we're going to add to the costs in there. Printer in cartridges. So as I said before, fixed assets, something that we're going to use over a period of time in here, these non-current assets, which are fixed current assets. And this is a current asset because we're going to use this printer in cartridges within the year. So that's not going to be there and being added to it. Desk lamp. This is interesting. We've got a low amount here. So when I said we were looking for the capitalization note, highly possible we're going to be tricked here and we're going to have something which is not going to, that's going to be lower than the amount. Let's have a look and see what we got. The acquisition remained under a finance lease. Right, okay, I'll give a quick explanation about finance leases here. So we've got finance leases and we've got operating leases. Okay, an operating lease basically is I've rented it. So what we're looking for is we're looking for what's known in accountancy as the substance of the transaction. Here, so let me just insert roll there. So we're looking for the substance of the transaction. And this is more important in accountancy compared to what's known as the legal form. So the legal form of a lease is that the person who's owns the asset initially and gives the lease is the one who owns it. So really, although we have this item, this furniture item on a finance lease, the legal form of it is that it's still owned by whatever the supplier was that supplied it. However, the substance of the transaction is that actually we own it. And the thing is that it's owned for, or the finance lease runs for most of the economic life of the asset. And what's really happened here is we bought the asset, and then at the same time as well, the company giving the finance lease has also given us a loan. So we got two things: we buy the thing there, and we also then have a loan going alongside it. And with an operating lease, we don't have a loan, so there's no loan. So this finance lease is then brought on the balance sheet, what's known as being brought on the balance sheet. So the item is capitalised, brought onto the balance sheet, as is the debt. And an operating lease, where we're just renting something because it's a lot less than the useful economic life of the asset, then we have just rent in the profit and loss account, the statement of financial performance, whatever you want to call it, but we don't have the loan brought into the balance sheet. So finance lease there, though, in case you were worrying, that's what it's sort of saying is that means that we have bought this asset effectively, and we've got our debt alongside it as well. We'll see what happens. Following rates of sale of item and factory machinery. So we've got a sale going on, we've got some kind of disposal. Now let's have a read of what the policy is. So policy is to recognise items of capital expenditure over 500. So we're going to bring in this corner office suite and this delivery and assembly charges. We won't be bringing in the desk lamp, and we would never have brought in the ink cartridges in any case. So we're going to go office equipment is depreciated at 20% per annum using straight line method. Right, okay, so let's just start writing some things down now. So the furniture is going to cost 2,100, and we're going 20% straight line. Okay. And the factory machinery is depreciated at 25% per annum using diminishing balance. Okay, so factory machinery is at 25%. 25% reducing balance. Okay. Depreciation is calculated on an annual basis, charged in equal instalments for each full month the asset is owned in the year. Alright, okay, that's interesting. So our timeline is very important then here. Let's get our timeline in. Where have we got one? Do you know what the year end is yet? No, we don't. So we'll have to see whether, hopefully that'll be on the next page. Alright, oh, we have got it. There we go, there's the 30th of June. So let's get this in here. Let's start with June. And important really in an exam, have a ruler and make sure that you, so if you July want it. There you go, get a ruler, make sure you have it there though. Makes it quite easy as well, because let's say we're doing here, I don't know, 1 centimetre to the month, with 12 centimetres along. So 30th of June X3 in here, and so we bought this thing. When did we buy it? 1st of March. Right, so we bought it on the 1st of March, so I'll keep that in, it's going to be interesting. So for the year ended 30th of June, following an extract from the non-current asset register below. Any acquisitions of non-current assets, any disposals of non-current assets, any depreciation for the year ended 30th of June, and an extract on current ledger here. Okay, so let's kind of move on then. So, acquisition date. So we've got this factory machinery here, which I think if we went back here, we disposed one of them. Which one did we dispose of? MN864. Right, so we disposed this one here. Okay, so we've got disposal there. Now, did we have factory machinery depreciation, annual basis charge and equal for each full month the asset is owned? Right, okay, so depreciation charges in the year is going to be 0 because we've disposed of the item. 0. Wonder if we'll be able to copy that. No. Okay, insert shape, and a 0 for the carrying amount. Oh, right. Oh, there's our answers as well. So we've gone 0 and 0 over here for MN 864. Disposal proceeds, we haven't. Do we got those? Date of the sale. We've got a selling price 1050. That's going to go in. Disposal proceeds 1050. And we would also put in the disposal date as well, which I think we decided was the 1st of July 2002. Right, okay. 1 July X2. Okay. Allowed us to do that first bit, that first line. There we go. Okay. Let's now go to the next bit then. Where are we going for? We've got a machinery 892. No more, nothing else has been done to that. Right, so now we've got machinery, and remember we had that strict rate balance. So we've got our carrying amount at the end of X2. So our carrying amount here. So what's it? 982 is the machine, wasn't it? Our carrying amount here. Let's slide that along to the right a little bit. Our carrying amount was 7050. 7050, and we're saying that it's 20%, 25% reducing balance. So equals that times by 0.25. So reducing balance is just basically what is the carry-in value in here. So let's go back, and we've got a 17265 to go in here. So our insert our shape. 17. I'm not even sure whether this is actually part of the assessment because I can't see any drop-down boxes, but I'm not going to waste the opportunity anyway to do this. And so then our carrying value at the end of the year is going to be 5287.5. Insert our shape here, 5287.5. Now what you'll notice as well is sort of sliding backwards and forwards and what have you. Instead of, by writing it down there, but instead of having it or just on my calculator, what have you, I can at least go back up to the electronic version, what you'll have in terms of when you're doing the exam, and just put it in. Right, so we've now got this office equipment here. OF47. Oh, what else have we got here? So we got this office equipment here. We bought it in part exchange. It's been written off a bit over here, and we've got 25%, or we've got 20% reducing balance, haven't we? Well, to be fair, actually, let me go through and do this one here. We haven't got we've got last year's depreciation. So if you're looking for the depreciation, let's say on this one, what we would have in terms of straight line, you're looking for cost, you're looking for residual value. Cost minus residual value, and then it would either be times by depreciation rate, or it would be divided by a useful economic life. So you would have one of those two things going on: cost minus residual value times by depreciation rate, or cost minus useful value divided by the useful economic life. What we can see here is these two items here: the depreciation and the depreciation rate is basically 1 over the useful economic life in terms of years, and so I'll see what we've got here, but we haven't got anything here to tell us what that would be. Yeah. But we do have last year's full cost, so that will be 2588. 2588. Insert another shape into there. So our carry forward would be 7177. Okay, let's just go. Okay. Right, so that's that one. This seems to be where we're going to drop in our shape in here. This is where we're going to drop in our new item over here. OF477. It's going to be that one that's going to drop into there, and now we're going to have funding methods, so we're going to put finance lease into here. check. Yeah, we have got that one available. Finance lease there. Bit of a wasted question that really. They could have given the explanation. Let's say that the lease runs for 4 years or something like that. Maybe that's at the next level. Right. So cost, which is going to be in here. What did we have as our cost? Our cost was 2,100. Because we brought in the item for the delivery charges, because it was whatever's required to get it into place. We've got our depreciation, and if you remember, our depreciation was based on a monthly basis, equals to each full month. So we bought it on the 1st of March. So we'd have March, April, May, June. This item here. So you've got 4 months. Right, if you want to do that and you do it on your fingers in terms of March, April, May, June on your fingers to get most, so we've got 4 months worth in here, 20% straight line. So 2100 times by 4 divided by 12 times by 0.2 is going to be, I think 140 is going to be our depreciation charge. Depreciation charge there. 140. Carrying amount is going to be that amount less the 140, so that's what it's going to look like. Our carrying amount is going to be that 1960. New methods of the finance lease. Let's just slide that down next to it there. Though we're not disposing, we're not doing disposal dates. So that is actually, we'll leave that because that's where they put their little box. Okay, so that's our part A. Right, and we've got those in our options as well. So complete this following sentence. The non-current asset register is right. So let's have the option. Part of the general ledger. No, it's not. So if we've got our, you just go here and give some. We've got a general ledger here. Ledger here, where all of our double entry bookkeeping all sits, all of our control accounts, everything to create the draft trial balance. Out here is our subsidiary ledgers, various ones of them. And one of those is the fixed asset register. So it's just a check in here. So it's definitely not that answer. And we use the fixed asset register or the non-current asset register as it's described here as a check against the general ledger. So we don't do that then. A list of the business's intangible non-current assets. No, it's I mean, it's been a little bit obtuse here. It's a list of the business's tangible non-current assets, so things you can physically hold. Intangible ones would be things like brands, if you wanted to, or goodwill that we bought, things like that that we're trying to capitalize, that you can't actually physically touch. Part of the business internal control systems, that's a good one. That's going to be a test in terms of, remember, we'll come back here, we've got our general ledger here. We've got our subsidiary ledgers in here, of which one of them is the non-current assets or the fixed asset register, and we could be using that as a test to check backwards and forwards. Recording the statement of financial position. No, it's definitely not. No, because the statement of financial position would come from the general ledger, well, the trial balance generated from the general ledger, so it's definitely not that one. So it's number 3. There we go. Okay, and that's going to be the part of business internal control. Okay, that's that one. Checking physical non-current assets to entries in the non-current asset register will enable the business to. So what this is let's say if we're in an audit, this would be a physical verification check. So often you go around and you check the physical verification of them. Is an asset where you put it? You know, often in a fixed asset register, you would also have location sitting in there. Though, is it where it's put, or has somebody decided to move it somewhere else? You might have put it one place, somebody else thinks it's a great plan to put it somewhere else, or alternatively somebody might have stolen it from you, so you're trying to sort of check it. Similarly as well, if you go around and you find a big piece of kit and then it's not been put into the fixed asset register. Sometimes you can have companies that attempt to reduce their profit in a particular year by not capitalizing items. So ensure that depreciation has been calculated correctly. That will not make a fine bit of difference because depreciation is a calculation done in the general ledger, and so you can't physically test that. Verify that double entries in the general ledger are correct. Possibly in terms of an error of omission, but we're a bit obtuse there. Identify non-current assets not in the register or in the register that do not exist. That's way better. That's what the purpose of a physical verification test is. Sorry, just dropped the book off the edge of the desk. Right, so that one's going to be the identify non-current assets. So that's the answer for that one. And ensure all revenue expenditure has been correctly recorded. So that's almost like the sort of the absolute nonsense answer. Right, so that is that question done there. I think that's it, really, for the first bit. Right, let's move on to question 2. Okay, so task 2. This task is about recording non-current assets in the general ledger. Okay, so fixed assets in the general ledger, and other non-current asset matters, so other fixed asset matters. You're working in the accounts for business that registered for VAT. So we've got VAT in here. We've got VAT. Okay, and working on the accounts, the business year end is 31st December 2004, X5. Okay, I'm not quite sure why they don't just put proper years in. It would be a lot easier. Right, okay then, so, and this is X5. Right, so we've got our timeline in. That's how we're getting on with things. Right, so on the 1st of September, the business bought a new motor vehicle costing £15,000, excluding VAT. Okay, this was paid from the bank. So, on the, when was it? 1st of September. Okay, so on this one here we got car, £15,000 net. You got VAT of 3,000. And we've got the bank here of 18,000, and let's put those into some kind of debits and credits just so that we don't get this wrong later on. 15,000 there. We're going to reclaim the 3,000 VAT, and we've got 18,000 credit for the bank. Right. See where we're going next. The residual value is expected to be 3,000. Okay, excluding VAT. So we've got some kind of residual value going on here. So let's just set up our cost and res value. So we're going to go cost 15,000 quid, 3,000 residual value. That's sort of telling us where we're going. Now we need a rate or a useful economic life for our depreciation rate. The business depreciation policy for all motor vehicles is 20% straight line. Okay, so 20% straight line. So we've got cost minus residual value. Okay, times by 20%. Okay, so that times by 0.2. So that's going to be our depreciation whenever we need that. Let's see where we're going next. Full year's depreciation is charged in the year of acquisition, not in the year of disposal. Okay, depreciation has already been entered into the accounts of the business for the existing motor vehicles. A, calculate the depreciation charge on the new motor vehicle. Right, so it's a full year. Okay, so a full year. There. And that would be 2,400. In terms of, and so it would be full year. Okay, so that's that bit out of the way. Make entries to the accounts for the purchase of the new motor vehicle, depreciation of the new motor vehicle. Okay, so easiest way to do this then is, let's not always get this in terms of your, always do T accounts. Easiest way to not get things wrong. I'm going to give you the full version here. I've got some T accounts here, so let's go car, VAT, bank, accumulated depreciation, and the depreciation charge. Another one. I'll put it over here somewhere. And depreciation charge. Okay, so we'll go debit 15,000. And the reason why you do it like this is that you can always check then that things, your debits and credits are on the correct side. So there we go, there's our first journal, and the cumulative depreciation is going to be credit. That's a reduction in the value of our assets, and it's an expense, so that's a lower amount available for our shareholders, so it's a debit. And so those are our double entry bookkeeping things there though. So it's going to be motor vehicle at cost. Okay, so insert some shapes in here. I think it's going to be going what have we got available to ourselves? Pick list here. Bank somewhere. We've got bank available? Yep, we have. So we've got bank in there. That's going to be 15,000 going into the motor vehicles at cost. $15,000, and so our carried down. I'm assuming carried down must be in here somewhere. Where is it? Balance carried down. Yep. Balance carried down, and insert our shape over here, and that's going to be 50,000. Oh, actually, sorry. Let's get these on the right side. It's going to go bank into there, isn't it? There's our debits. A little bit annoying, really. I mean, it would be nice if it put the things centralized it and like that. Then okay, so there's our balance carried down, 50,000. For that one. Ping in the background there. Right. So next one, motor vehicles cumulative depreciation. Okay, insert our shapes here. So we're going to have a balance brought down, our depreciation charge. Where have we got? Depreciation charges. And that's going to be going in into our shape over here. 2,400. And we'll have on the other side our balance carried down. So that will be 11,800, won't it? Into that. Right, and that's got that one done. And then what we got over here, we'll have our charge in the year. The depreciation charges here. Motor cumulative depreciation, won't it? Where we're putting this. Wouldn't really look like this in reality. Actually, what you would have in reality would you'd have journal numbers, but it is what it is. 2,400, and then this is going to be a transfer to the profit and loss account somewhere. Oh, we're not going to go for that. We're going to put it into the should have somewhere profit and loss. Oh, there we go. There we go. We've got it there. There's our transfer to the profit and loss account. Over here, and let's put the total charges for the year in here, which would be 8,740. That's the opening part of that. Right, okay. When non-current assets are depreciated using the straight line method, an equal amount is charged for each year of the asset's life. That is going to be true. I'm going to explain why. So let's put in here. Okay, so whenever you switch on certain functions within Excel, like insert graph, it switches the video off. So what we've got here then is I've put in here the straight line amounts. Really, we're deducting off 2,400 each year, and in here I come up with a figure that's roughly the same in terms of reducing balance. And here, what you can see in the straight line is that we do reduce the same amount each year. So it's always going down by the same amount. And here, reducing balance, it comes in and a bit of a curl, more being lost in the first years and then less as we're going forward. So that's the difference between reducing balance and straight line really in here. So let's go back to our answer and insert our shape in here. And so that one's going to be true. Okay. Right. And a business sells a motor vehicle and receives part exchange £5,000 on replacement vehicle costing £20,000. Ignoring VAT, show the journal entry required to record the part exchange allowance. Okay, so this is going to what we got. We've got a pick list here. We've got some banks. We've got bank there, which won't be useful for any of them. And let's go over to the next page and see what else we've got. We've got depreciation charges, disposals. It's not really giving us anything in terms of depreciation charges, is it? It's not helping at all on that one. What else have we got? Disposals. Well, that will be in there though. Motor vehicles accumulated depreciation. Motor vehicles at cost. Probably going to be what we're going to need here. Motor vehicles running expenses. Profit and loss account. Purchases. Okay, so what we're going to need then in here is going to be our motor vehicles at cost, probably, because that's all that we've got available to us. And what else have we got as well? Disposals as well. So what you would normally see or be looking for, now let me just go and open up another sheet of workings. So you normally be looking for in our T accounts the accumulated depreciation and the cumulative cost, and we'd be normally looking for that kind of thing, but we don't have it here. All we got here is cost, motor vehicles at cost, and that was all we were actually given really. And we're going to have this. Okay, so all we've got, normally we'd have a cumulative depreciation here as well, and we might have some, let's say we sold the item for, and we would also have another third one, which would be profit or loss and disposal of assets. So let's say that we sold it. This would be a credit for 10,000. Or let's say we sold it for 10,000. Oh, sorry, sold it for 5,000. Let's say we'll go through this again. Here. So we had our sale, and let's say it was sold for £5,000, and in there we had our accumulated depreciation. So that's going to go into bank, let's say, in here, and the cost of the item was 10,000, but it had accumulated depreciation of 3,000 on it. Oh, sorry, 7,000 on it, let's say. So the profit on disposal would be 2,000 there, and that would then lay out in like here in terms of debits and credits. So our bank would be our debit of 5,000, our cost would be credit of 10,000, our cumulative depreciation, we would get rid of it out of the cumulative depreciation, 7,000, and our profit here would be the additional 2,000. Okay, so it would look like that, but that's not what we've got here. All we've got here really is a motor at cost, and that's going to be a debit of 5,000, and we're going to put that back into the motor at cost, in other words, disposal, and that's going to be credit of 5,000, both of which would go into the motor vehicles at cost account. Let's see what we got here available to us. Back to that. So the account, insert shapes. Yeah, not the greatest of questions, because really it could all be motor at cost. But I'll put a disposal one in there as well. Because I'll assume that we'll have two different accounts, because we've only got really disposal. It's not disposal of motor vehicles. You'd want it as disposal of motor vehicles so that it would be much easier to create the accounts at the end of the year. Because what you would have in the fixed asset note at the end of the year, it would be going, say, brought forward, acquisitions in year, and disposals carry forward. Cost. These ones, and you'd have all these various items of land and buildings and what have you, and motor, etc., and furniture, let's say. And you'd be dropping those in there. This would be the line here, disposals and motor vehicles, so it should really have some extra words in there, but it is what it is. Okay, disposals is what we're going to have to pick, and in there the motor vehicles at cost will be a debit. 5,000 going into there. They've got some ticks, but I'm not really going to do all of it like that. And the credit would be the disposals here. Okay. Okay, let's get on with number 3 then. So, this task is about the sales ledger accounting. Okay, great. Including accruals and prepayments. Right, we're going to see a lot of timelines being used here. And applying ethical principles. Oh, that's nice. Right, so enter the figures given in the table below in the appropriate trial balance columns. Do not use zeros in unused, or do not enter zeros in unused column cells. Do not enter any figures as negatives, because you wouldn't. You don't do that. Debits and credits don't have negatives in there. Extract the trial balance as at the 30th of June 2014. Okay, purchase returns. Right, so let's go back into assets. Equals, just an equal sign please, liabilities plus equity. Right, so here's our accounting equation in here. Right, what actually happens in here, the purchase returns, so that's a reduced expense. So we've had an expense, purchases, we've reduced that expense in there, so that's more money available for the shareholders, and the shareholders want it. So that one is going to be a credit in there. Okay, discounts allowed. Okay, so discounts allowed would be a, we had a sale, you know, and we've got this debit amount, this amount that they owe us on this amount in here. However, we said it's okay. We won't. Well, actually, we had a sale in there, but we've given them a discount for it instead of so a discount actually on the sale in terms of, I don't know whether it was a trade discount or amount for the amount that they purchased in there. So the sale is less in there though, so less money available for the shareholders, and therefore that would be a debit. Discounts received. So we've had a purchase, we've gone out and bought something, we received a provision for that. That would be a reduced expense, so it would be more available for the shareholders, so that would be a credit. And office costs, that's an expense. That's less money available for the shareholders, so less money that can go out to the shareholders, and so that would be a debit. Right, okay. So that one there, so what we're seeing then is credit, debit, but that's also the explanation about how it would be done. Right, you are working on final accounts for business for 31st December 2003. Right, so remember it sort of mentions some accruals and prepayments, so we're going to put our thing in straight away here. January and all the way through until December, like that. X3. Right, let's get our timelines in here. Business policy, account for accruals and prepayments. Okay, an entry is made in the income and expenditure account and the opposite entry into the relevant asset or liability account in the following period. The entry is removed. Yeah, okay, right. Okay, so we actually removed. So what we've got is that it's telling you it does reversing journals. So on the first day of the following period, we're going to have a reversing journal removing it. Okay, you are looking at the interest. So what this is telling you, why does it say this in here? If the policy was that it's not removed, we would then have our journal entries as being net entries. So we would only have the change between the opening and closing balance in there. In this one here, it's saying that no, we're setting up reversing journals here, so that the closing balance is immediately reversed on the first day of the following period in there. So you're going to post the full amount in here. So that's why it's sort of telling us, and that's what we're prepping up for in reality. Okay. So you're looking at the interest income for the year. Okay. As at the 31st of December, there was an accrual. So at the start of the year, we're going to an accrual coming in. So start of the year, 750. Actually, what I'm going to do is I'm going to set this up in actual calculations in here. So credits as being negatives. We'll switch it back to credits and debits when we get later on here. So we've got an interest accrual, a liability coming in there on 750, and that's also as well make sure that we set up our T accounts. Read a little bit more first, but we're going to have some T accounts written out for us and see what's going to go on. Let's get some down here. Ooh, drag that a bit. Let's just get a load of them out there and see what's going on. Right, okay, so we got our interest, so we got the cash book shows receipts and income of interest income. Okay, so accrual for interest income. Oh, right, so accrued income as we're going through here of 750. So what we've actually done then is we've accrued income. Now this is going to be interesting. Actually, it's accrued income, which means it's an asset. That was tricky. Right, okay, swines. That's a bit mean, isn't it? An accrued income in here of 750. Cash book shows receipts of income in this year of 4875. Right, so let's go through in here. So let's go interest income. How mean is that to actually use an accrued and an interest, which is typically would be an expense. Right, 7850 in here. We would have reversed this accrued income in the following period. In there on the 31st of January 2004 x4 needs 900 and income, right? So income for the quarter ended 31st of January, right? Okay, so January 31st, the quarter ended. So quarter is 3 months, 3 quarters in the year, so that'll be 3 months in there. Though, let's slide that back in here and let's just colour that. Ooh. Is my mouse not doing great this morning? Oh, behave. Right, okay, so there's our thing here. So 1 month outside the year and 1 month, 2 months inside the year. So all of this payment in here, what did we get? £900. 900. So divide that by 3. So 300, 300, 300. The accrued income would be the 600, the 2 months that are in the year. So you see, we've got then is we had that 750. We had another. We had 4850 minus 750, relating to 4,100. We've received that related to this period here. Okay. Then we've had this gap here. We got this invoice after the year end. Okay, actually I'll put that as the third one. 3 months there for that, because it's 3 quarters, so 4 quarters and 12 months. 3 months in each there though. That one is outside the year, so we don't want that. These two are inside the year, so we're going to have that. So that is going to be accrued income in there. Oh, sorry, actually, let me slide this the other way around. Totally rubbish. 750 there. 7850 there, and accrued income here at 600, and here would be our accrued income asset. The statement of financial position, 600 there. Right, here we go. So please prepare the interest income account for the year ended 31st December 2003. Close it off. Right, so we reversed that one in there though, so let's go back to here. Reversal of that accrued income is going to be a debit, so that's going to put that in that position there. Okay, we've got our profit and loss account. Where we got? So we've got some accrued income. What have we got else in here? Because we've got the 4,800. So we've got our bank, haven't we? Because we got it said it was in the bank account. In the bank statement, so we've got a bank statement in here. So let's just go through and list this in here. So that would be bank in here. This is going to be our year-end adjustment, or whatever it's going to be. We'll find what we got available in there. There's our reversal in there, and our transfer to the profit and loss account. Ooh, profit and loss, not profit and lose. Profit and loss account is going to be. Now, what I'm going to actually do is I'm going to slide this down and I'm going to show you the method that I like to do here, which is to make sure that this is just simply right. Right, is to add them both up there though, and then just take them one from the other and actually have it on my sheet. So 4,700 would be what would be going on there. So that wouldn't be how it would look on the exam. That would be how it would look on your paper. It means you don't go wrong there. So 4,700 is going to be to the profit and loss account. 4,850 is from the bank account, and 4,000 and the 750 is the reversal journal. You also got 600 in accrual going in there. Right, so let's just, so it'll look something like that. I can't do it on screen, it looks a bit of a mess really here. Okay, so we're now looking at selling expenses for the year. So selling expenses for the year, so expenses, great, okay. So you got 1,445 accrued at the start, so let's just go to here then. Selling expenses, and let's have a go for accrual. We'll line this up as a liability because it's been a bit annoying really. This would really just be called accruals. Right, okay, what have we got here then? 1,445 at the 31st December, got a timeline in here, so we got minus 1,445 because it's a credit, and selling expenses. So we're going to, that would what we brought forward, so we're going to reverse that out, I'm going to debit it at the start, and we're going to credit that as well. So that's going to be our reversing journal. In here, the reversal of the accrual is dated, well, it's dated straight away afterwards, so it'll be 1st of January 2003. Okay, let's see what the next page says. And it would be a debit. Oh, sorry, no, hang on a second, it wasn't a debit, no, it wasn't, it would be a credit, sorry, so I put it on the credit side, didn't I? So it would be a credit there. And it is on the 1st of January X3. Now, this is just a convention really in here, and what it says, and the reason why it was on the 1st of January is because of this statement here, that in the following period this entry is removed. So if you set up what's known as a reversing journal, it's done on the 1st day of the following year. If it would have said it's not removed in there though, it would have been done, the journal would have been done on the 31st of December in there, and it would have been the net adjustment in the accruals. Right, so I think that clears that lot out. Yeah, and you can see as well how it's much better to have your piece of paper and you're writing out your T accounts, because you notice how I was just looking at the screen in there though, and just snapped and said debit rather than credit. But if I had my piece of paper actually underneath my screen, unfortunately when I flick backwards and forwards on my laptop, then you could sort of see, well, yeah, no, that's a credit, and then I'm just trying to make sure as well at the same time as doing this of giving you rock solid exam technique. Right, this is useful as well to see where I occasionally would go wrong if I did it just straight on the screen and didn't do it with a piece of paper as well next to me. Right, the cash book for the year shows payments of selling expenses of 5,400. Right. Sorry, what did it say? 5,770. Okay, there we go. There's our expenses from that cash book. Okay. In April 2000X4, an invoice of 3,180 was paid for selling expenses for 6 months, ended the 31st of March X4. Let's go back to our timeline then here. So we're going to go out in here, and you can be finished now. Well, I'm going to leave it. I'm going to leave it in because it's quite nice, so you can see exactly what I would have on my piece of paper. So let's go back here. 6, 5, 4, 3, 2, 1. Right, that lot's outside of the year here, so they're no use to me in here. And this lot I want in my year in here. What was the expense again? It was 3,180, and it's 3,180. So equals 3,180, and divide that by 6 months. So 5,300 for each month in there though. And there we are, 5,300 in each month. Oh, come on, slide you along. Right, and so the accrual, the amount missing, is going to be those 3 months, 5190. Right, let's see where we're going then next. Taking into account all the information, calculate the selling expenses for the year 31st December 2003. Right, okay, so we've got our selling expenses here. This was what comes from the cash book. Now, what we're going to do in here, we've reversed out our journal there. We're then going to credit 5190 over here, and we're going to debit 1590, sorry, over here. And there, so that's going to be expenses. I'll do it the way that I like to do it in the exam on my paper, which is just to total up both sides in there, and to total up that there, and therefore carried down is that number. So the transfer to profit and loss account is going to be that. So it's going the selling expense will be 519. Where is it? Back into here. So it was 5915. Yeah, so that's what will be going into there. Let's just complete it, shall we? 5915. Okay. This is your first year of preparing accounts for this client. The owner of the business asks you not to record accrued interest income in the accounts for the year ended 31st of December 2003. She's trying to reduce her tax liability. Right, okay, well here we have our professional ethics going on here. She offers you a free week in her holiday cottage. Alright, so we've got a threat based on self-interest, have we? You're very tempted because you've not had a holiday in a long time. Oh, behave. You're not tempted at all. Because that would be terrible. Right, okay, so it's self-interest, really, isn't it? If it was self-review, let's say there was no point where you've been asked in there, you're just simply reviewing your own numbers and you decided that it wasn't a good idea, probably because of your competence. If it was intimidation, you said, no, I'm going to have my tax lower, and if you don't do that, I'm going to send round my very unpleasant, I don't know, brother or whatever. In there, and familiarity is, oh, come on, we've been here friends for a heck of a long time. You've been going to my holiday cottage for years and what have you. Can you please do that for me? So no, it's self-interest in this one because she's offering you a bribe. Right, and that is the end of task 3. We're into task 4 now. We've had a little chuckle in task 3 over a bit of a bribe. Right, so here we go. The task is about preparing accounting adjustments. You're an accountant preparing financial accounts for a business for the year end December 2005. Let's lay out our timeline because we always like to do that whenever we're given the time. Makes life a lot easier. January. And let's go and slide this now across all about. Oh, come on. Obviously a lot easier on a piece of paper for yourselves. Slipping a little bit with Excel today, don't know why. January X5 in here. Record the adjustments needed on the extract from the trial balance to deal with the items below. All right. Oh, great. Oh, that's quite nice. We got an extended trial balance question. Oh, lovely. You will not need to enter adjustments in every line. Do not enter zeros in used cells. Okay, fair enough then. An allowance for doubtful debts of 3,200 is required at the year end. Right. So where we're going to let's find our allowance for doubtful debts. So we've got our opening position in here. Now, and we've got our adjustments, and we're going to have an expense somewhere as well within here. So that's going to be our statement of financial position balance sheet one in here, and this one's going to be our transfers to profit and loss account. So let's do this now. Don't get drawn in to just doing this straight away on the actual exam. So now put in your T accounts. So let's create some T accounts here. And we're in an extended trial balance question, so we're going to have a lot of them. Okay, so just put in London. What I would tend to do is I would be putting, actually I'll do it exactly how I would do it in the exam. Let me clear that one out for you. Delete that. In fact, I'm going to take those ones out as well. The absolute perfect method of this especially if you're going into chartered accounting exams or later on, is 3 to the page, 3 to A4, 2 across and 3 down. So thing, right? So what we've got then here is doubtful debts balance sheet and doubtful debts P&L. Notice how I'm sort of using the simpler terms in there, though. So this would be doubtful debt statements of financial position, doubtful debt statements of financial performance. I just think it's a silly mouthful the way that AABT go about it. Right. Okay. So we've got 3,200 at the end of the year, so that's going to be the carried down in here. We've got 2,888. 2,888 there though. So the difference has got to be the journal here, that minus that. So we're going to go, we must go, sorry, let's be the other way around. Make sure it goes that way. Right, so our carried down here will be there, our brought down here will be this one in here. Let's just go back, see, yeah, okay, so that one's going to slide into the, there will be 3,200 in here. End. So we've got to adjust for 312. So 312 is going to go into there. Okay. And it goes into the credit side. 312 into the credit side. And then here we must have, if we've got that in our credit side, we're going to have that in our debit side. So we're going to go that. Now notice how as well it's just terminology. We've got doubtful debts here, which is we know we've got some debt that's not going to pay, we just don't know who, as opposed to irrecoverable debts, which is that we definitely know that they're written off and we'll never see it again and they'll never exist again. It's that company's gone into liquidation or administration. Right, so that's the first one there though. So we've done that one. A total column of 1885 in the sales retained return book was debited to the sales ledger control account. Okay, right, so sales returns here, and the sales ledger control account. Right, so a total from 885 from the sales return day book was debited to the sales ledger control account. All other entries were made correctly. Right, so let's go through here. So it went sales returns in here, which would have been debit 1885. And this is where setting up your T accounts is correct. So we went debit because that was the correct figure in there, 1885 from the sales returns book. Okay. But we also went debit 1885 here. Right? So what we need to do then is we need to go and we're going to reverse out that one and we're going to put in the correct one. So you can see here you got 2 credits, so what you actually need to do then, we must have a suspense account down here. So that's going to be the other side of that. So journal number 1 is going to be debit suspense 3770, and it's going to be credit sales ledger control account 3770. Okay. So that's where we're going on that one. Let's go and find out where this one then is in here. Sales ledger control account down here. So we're going to be going credit the sales ledger control account. We must also as well have somewhere a suspense account. Oh, there it is there. But it's not 3770. So let's not panic. We must have some other errors somewhere along the lines. Okay. So we've got that in there. Closing inventory for the year end has not yet been recorded. Ooh, excellent. Its value at cost is 13,185, including figure. Some items cost. Right, okay, so stock, and okay here, or inventory, or stock, whatever it is we want to call it. So we've got, where are we? Closing inventory. Statement of financial position, closing inventory, statement of financial cost. Right, so closing inventory 13185. 13185 is an asset, so it'll be our debit side. There, and within that figure, 15871. Right, okay, so 1575 will be sold for 1400. And the reason why stock is either carried at cost, the lower of cost, or residual value. Yeah, so and this is a concept called of prudence, really, and it's true and fair, really, actually, is that you do not recognise your profits until you earn them, so the year in which they're earned, but you recognise all of your losses immediately, so you get a statement, an accurate statement of financial position. So even though this here, the difference between here will be sold within the year, in here, so actually what we're going to be doing is it's going to be a net figure 174, so credit 174. So we're crediting 174 in here, and a lot of that will be sold in future years, so some year outside of our timeline over here somewhere. Because it's a loss, we recognise it immediately, so we're going to have a credit of 174 in there. Let's go back to our tasks. Sorry, here we go. So we've got our closing, we've got some kind of cost here, we must have some write-off somewhere. No, oh, that's a bit sneaky, isn't it? You see that irrecoverable debts there versus our doubtful debts? Just going back to that comment which I was sort of saying, that's something which we definitely know the debt, who it is that we've lost there, and we're definitely not going to get it. And this one here was a doubtful debt. That's sneaky, that one, isn't it? So we would have our 174, and that's going to go in somewhere. But what we're going to see how that trials looks as well. We must have something else in there. And a discount received for 836 was credited towards the purchase ledger control account and the discounts received accounts here. So let's just go through and work out what our closing stock would be. So our closing stock then is going to be closing stock is going to be that minus that. Okay. Oh, and I think I meant, sorry, let me just go through here. Closing stock figures there. Okay, so let's get that in now, because we're reading the rest of the question. We haven't got any other adjustments to our stock figures. So statement of financial position. So that's where the asset's going to be 13010, and the same figure is going to go into our statement of. Ooh, let's not do that. Just copy this over, and the same figures going to come in copy that, and then let's just not bother. Insert shape. The same thing is going to be a credit to our statement of profit and loss account. Let's move that across a bit, make it fuller. There we go. So that's what we would have there. A discounts received has been credited to both the purchase ledger control account and the discounts received account. So let's go here now. Ooh, let's set out some more T accounts. Now, if you're in an exam and you're not getting enough paper in here, so they only give you a couple of sheets of paper, whatever, immediately put your hand up and get more paper for your workings. Discounts. Don't, and if you do end up with a situation where this is continually the case with your invigilators, they complain to your tutor. Right, so discounts received. Okay, so we've got discounts received and we've got our purchase ledger control account. Okay, and the discounts received, so it should be a credit. And so what happened in here? A discounts received for 836 credited to both the purchase ledger control account and the discounts received account. So we credited 836 here, which was in the right place because it's a reduction in expense, so greater income will go out to the shareholders, so it will be a credit. But we also as well credited it over here, and we should have debited it because it'd be a reduction in the liability going out, so that would be a reduction in money out, so that would be a debit. So what we would have here would be suspense here equals 836 times by 2. Sorry, no, credit the suspense. Sorry, credit the suspense. There, let's put that there. Purchase ledger control account will be. You went credit there, did we? And we should have gone debit there, and it's debit the purchase ledger control account. So debit the purchase ledger control account. Let's put that one into there, like that. Come on, slide down Excel. Thank you. So that's how our journal should have looked. Let's then put that into here, 1672, into there as well. I think we've got a brought forward in there, and I think we've run out of items. So let's just see whether our sales suspense 2098 here. Yeah, on the credit side. Yeah. Hopefully this should now balance. Let's see, and if that does, then we know that we are. Yes, we do. Great. Okay, so we know that that's the right answer as well. That's always quite comforting in the exam. Breathe a sigh of relief that we got this correct. So our discounts received is going to be 830. It was fine, wasn't it? It's the purchase ledger control account that we're going to have going in there. So our suspense account. Let's go put another one in here. Insert our shape. We went debit the purchase ledger control account, didn't we? And what did we debit our purchase ledger control account with? 1672. 1672. And then we've also now, in total, with those two amounts, debited our suspense account, 2098. Let's just go back and just. I think that is right, isn't it? Yeah, we went debit purchase ledger control account 1672. We credited in net our suspense account 2098. So that's that, and that looks to be the end of that question. Great. Okay. Just check. So that would be the net. I don't know whether are we supposed to put it in a net, so because are we supposed to put them in totals? Go back and just check this. Your accounts now need to make some adjustments for the year end. Record the adjustments when you send them right. You will need to enter adjustments on every line. Do not enter zeros into unused cells. Okay. To be honest, just for neatness, I'm fancying putting the adjustments in as each as them separately, just in case there is some kind of electronic method that's searching for both of them. So that's really how it would look. Probably, actually, in fairness, easier to do as well, because you can see here there's a debit and the credit, there's a debit and credit, there's a debit and credit, and there's a debit and credit there. So you always just a neater version, and quite nice, really. Right, the ledgers are ready to be closed off for the year end. Okay, show the correct entries to close off the irrecoverable debts and insert the appropriate narrative. Okay, here, so. To close off the irrecoverable debts and insert right. So what we're going to do then here is to close off the irrecoverable debts. Then we are going to go sort of debit the profit and loss account, credit the thing there. So what I'm going to show you is exactly what happens here. Let's put this figure over here, like that, and this here, like that. So we got our irrecoverable debts. Irrecoverable debts, and we've got a figure in here from our trial balance, which is, what is it? It's 790, and it's quite a nasty question, this really, isn't it? Because you can see how they were trying to drag you around with the doubtful debts and irrecoverable debts, and we've got our transfers to profit and loss account. So what we're going to do is we're going to go credit irrecoverable debts, and we're going to go debit profit and loss account, and that's going to be transfer of irrecoverable debts to the profit and loss account. So that would be, well, we're just going to go, what was it? Irrecoverable debts, credit, profit and loss account, debit, and transfer of or close down in the profit and loss account. So yes, it's just a transfer from this account here into this account here. Right. Let's see what else we got then. Oh, what do we have available? Oh, we've got some options in here. So we've got our irrecoverable debts there though, and we've got our profit and loss account there. Okay, so it would have been credit irrecoverable debts, debit profit and loss account in here. Let's look at our available narrative in here. We're looking for some line transfer wording. Carry down on the balance. No, it's an item and expenditure for the financial period. Therefore, there would be no carry down. You carry down assets and liabilities. Closure of the general ledger. Not really. Transfer irrecoverable debts for the year ended 31st December to the profit and loss account. Oh, it's that one. Transfer irrecoverable debts to the statement of financial position. Oh, right now that's quite nasty, isn't it? So here, profit and loss account, sometimes also called the statement of financial position. If we were in a non-profit organisation, it would be the statement of income and expenditure. And here, this is the balance sheet in here. And this is also the statement of financial position as well. Statement of financial position being assets minus liabilities equals equity. The accounting equation being assets is equal to liability plus equity. Note the difference. Right. Okay. They're now in the process of preparing financial accounts, final accounts and trial balance. Normally you have 3 days to do this. Okay, about to go on holiday. You need to complete this work in 1 day. Oh my God, this is going to be a right. Okay. What type of period pressure are you most exposed to in this here? Time pressure, really, isn't it? What is the threat? It's the threat to your competence, isn't it? Okay, so question 5. Right. Okay, this task is about the period routines using accounting records and the extended trial balance. Okay. You prepare the bank statement reconciliation for sole trader. Oh, that's quite nice. Bank showing a bank statement of credit of right. Let's lay out a bank reconciliation approach really here. Let's go through. So we got now we will have something like a bank statement over here. I'm going to put it in a T account method. Always easier. Bank statement over here. Now, note what I do on why I laid it out like a T account method is because if we got some kind of opening figure that's laid out as a credit on the bank statement, I'm going to flip it to a debit straight away. So I've just got it as it from our perspective rather than from the bank's perspective. We'll probably have some kind of trick in here. I'm just sort of laying that out before we start. Right. Okay. Balance showing the bank statement is a oh, there we go, straight away. Oh, so predictable. Bank showing on the bank statement is a credit of 3,050. Let's just drop that in as a debit of 3,050 and put it from our perspective rather than from the bank's perspective. The reason why it's a credit in there is because the bank owes us. The bank statement's always from the bank's perspective, so from our perspective it would be a debit. Okay, and the balance in the cash book is a debit of 3,554. Okay, 3,554. Okay. Something nice before we even started. Okay, the bank statement has been compared to the cash book with the following differences identified. Okay, so we've had a tick. So what they've done first of all is they've ticked between the bank statement and the cash book, and we've got the following differences. If you're struggling on bank reconciliations, go and have a look at the AAT level 2 bookkeeping controls ones. I pretty much lay it out a very foolproof method of bank reconciliations, and we're going to use it here. So, standing order of 2,069 has not been entered into the cash book. Right, so what we got in here then is there would have been a 2,069 standing order. So what we've had there though, and so that was not been ticked off, and so that will be transferred into the cash book. Yeah, okay. A check received from a customer for 500 has been recorded in the cash receipts book, so in the bank statement, but the bank has informed us that the check has subsequently been dishonoured. Oh, boo. Right, so this would then be, we would have ticked what we got now, but there's now, so it's an adjustment in the bank statement, so a dishonoured check. So we would have to go 500 credit out there. Okay, actually what I'm going to do as well is let's fill out the rest of that. Let's do the additional T accounts just in case they're required. Delete this out. Give myself a few more as well when I'm at it, just in case. Actually, I'm going to put them down there. I always like to have my bank reconciliations to the right hand side. I'll clear that out. Got a few more down here. So I'm going to be going sales ledger control account, 500 debit to complete our expenses, and we've also got some form of expenses thing over here, which was debit 269, credit the cash book 269, just so we can complete our general ledger double entry bookkeeping. Always makes it nice and neat. A cheque for 940 to a supplier has not yet been presented for payment at the bank. Okay, so we've got 940 over here. Now, what I'm going to do here, check for payment, is I'm going to colour these in different colours. So this would be something that is missing, so it's not on either of them there. So that goes. I'm going to colour those ones there, which is our transfer across. So we transfer, and I usually like to colour something there, and that is something which we're going to have as an adjustment. Okay, so those ones aren't on bank statements yet. Okay, a direct debit of 485 to a utility company appears only in the bank statement. Okay, 485 on the bank statement, but not in the cash book, so that would need to be transferred over as well. So that's going to have to come across as well. Cash sales of 330 been recorded in the cash book but not yet banked. Alright, so that's just that's something that's going to go into the bank reconciliation over here. Let's go bank rec. It's going to be outstanding lodgement. 330 positive. Colour that one. Bank has credited interest of 114 to our account in error. Swines. Credited interest. 140. Okay. That was in error. There's their error. Will need to be posted though. Another all. Right, use the following table to show the 3 adjustments you need to make to the cash book. Alright, okay, so the cash book. Alright, enter only 1 figure for each line. So we've definitely got the utilities one that's going to have to come across. And there, that's going to be the number. Where's that? That was the 4. Standing order definitely comes across. So let's just go through. So we've already moved over the standing order. We moved over the utilities one as well. Yeah. And I think also as well we had to do, so standing order had to come across, yeah. The check from the customer is in summary, that one's got to come across as well into our bank statement. So that one had to come out, so that's an adjustment to it. That was our journal here. We had to adjust those ones there and that one there. Right. The 940 not yet presented would be the unpresented checks. Cold here today, so my fingers are a bit numb on that. Right, okay, so that's those ones there. So that wouldn't be an adjustment. That one's something not in the bank statement, and so that goes over to our bank reconciliation. So it's not that one. The direct debit, yeah, I said that was had to come across. Cash sales, not yet bank. That's an outstanding lodgement, so that would go in the bank reconciliation, not into it's already in the cash book. And the error then. 3 adjustments you need to make in the cash book, and only 1 figure. To be fair, we've already got 3 that are better, so those 3 are better. And though the error, you'd have to get onto the bank pretty quickly and get that error corrected, really, because you could, if it was at the year end, you could sort of say, well, actually, well, you probably wouldn't in terms of materiality. So it was number 1, number 2, and number 4. And what actually what had to happen then? Let's have a look. Oh, we got to come to credit, and we put them all as credits. So that was that one. Right. Okay. A debit on the cash book means that funds has available. that means the business has funds available. Yes, it does. If it was a debit in the bank statement, it would mean that that we owed the bank money. So, and just to show you, let's put this in as, make this a bit easy to read. Okay. Bank statement from bank's perspective. Okay, it would be the other way around. It would be 3050. Bank statement from our perspective. That there. So I like to take the bank statement from the bank's perspective, switch it into from our perspective on my piece of paper, and then I can compare into the cash book so that it's now all nicely lining up in the same way. We're basically reversing it around. So that's that answer. So that's just simply true for that one. Let's get on with it. This task is about completing an extended trial balance. Okay, we've got another extended trial balance to go. I think what we'll do then is we'll put in another sheet for that, and we'll just do this separate on a different piece of paper. As noted again, always get a load of paper in the exam. And showing your accounting knowledge. Oh, that's nice. Right, okay, you've got the following extended trial balance. The adjustments have already been correctly entered. Oh, right, so we've got some adjustments already in. Extend the figures into the statement of profit and loss accounts on the financial columns. Oh, do not. Oh, that's all a bit dull, isn't it? Right, okay then. So here we go. We're just going to basically pick which ones are statements of profit and loss, or statements of financial performance, whatever you want to call it, and statement of financial position, or balance sheet, however you want to call it. Right, so accrued income. Okay, that's a statement of financial position. So that's actually something that's happened, that still carries on into the next year. So that's going to be a debit in that figure there. So that one's just going to, I'm just going to mark these instead of putting them all in. So that accrued income there is an asset at the end of the year, and it's going to be used in the next year. Oh, it's basically going to, your income's going to come in the next year. It's an asset in there though, so that's going to be a debit. The bank is the ledger balance, and so that's another asset. That's going to be a debit in the financial statement of financial position. Capital is the liability to shareholders in the statement of financial position. So that's going to be a credit over there. Closing inventory in here. That's interesting. What have we got there? We seem to have wiped it. So we've actually got nothing to come in on that one. Oh, sorry, no, oh, I see what we're doing here. Oh, that's a bit lazy. Feels like we're going for. Oh, right, okay then. Normally you'd have this nicely laid out into two different lines: statement of financial position, statement of financial performance. Now this feels like we've gone closing inventory there with that one there slopped in, which actually should be going into the statement of financial position, and the credit into the statement of financial performance in here. Actually, what I will do is I'll copy this and I'll make this a bit smaller. If I can, let's just write this out on this sheet if we can. Alright, let's put that there. Okay, so we'll go accrued income, and we'll go P&L, debit, credit, and we'll go balance sheet, statement of financial performance. Obviously, we couldn't make it nice and simple and be the balance sheet that everybody uses in real life. Instead, we'll make that slightly complicated. Right, so 249 in here, bank 7281, capital, and so into shareholders. So liability to shareholders, credit, stock, inventory, whatever you want to call it. Right, we're going to have one which is going to be the credit to the. Remember, it's in the profit and loss account. The statement of financial position performance. It's going to be a reduction in expense. Therefore, it's an increase in the amount of income available for shareholders. Therefore, it's a credit, and it's an asset in the balance sheet. So that'll be 9. In the statement of financial position, so it'll be 9433 there. Commission income. Okay, that's going to be income in the year. So income is only that statement of profit and loss account. So that's going to be the net of that. So we've got 2 going on here, 74893 plus 249. Okay, and that's what we got there, and that's going to be our credit. Now, just to give you an idea of, let's say what the other one was. Let's say the adjustment was the other way around, and it was 249 on a debit in here. Just remember, if you wanted to put this as a number line, see, I'll put this as a number line here with our debits over here, which would actually be pluses over here, and our credits over here, and they would actually be minuses if you're an electronic system. So if this was a debit of 249, we would have gone 7893 minus 249 there, but as it was, 2 credits coming together, so they just added them up. Depreciation charges, that would be on the depreciation charges. So because it's a charge, it's telling us that that is going to go into the profit and loss account. If it was accumulated depreciation, it's going to tell us it's going to go in the statement of financial position in the balance sheet. Drawings, and drawings are against our liabilities to the equity, so it's a statement of financial position adjustment really here, drawings. So that will be a debit against them because we owe the shareholders less. So our liability to the shareholders gone down, so that'll be a debit. The general expenses, that's just going to be into the profit and loss account. Our income and expenditure goes into the profit and loss account, so that's going to be a debit into there because we owe our shareholders less, because they just got they get basically everything after the assets and liabilities have gone. So our machinery, we've got a purchase in there, it's an asset clearly, and we're going to add on that other debit as well. Ooh. Okay, so there's our machinery in there. Our machinery, oh, right, okay. Accumulated depreciation. On the machinery is going to be, it's a credit because it's a reduction in the value of the asset. 500 minus, oh sorry, plus 14600. Okay, that's our accumulated depreciation. Right, our opening inventory is transferred to the profit and loss account, and so it's transferred as a debit, as an expense. Yeah, 254. So what you can see here is, oh, we've got the closing inventory yet. There's the closing. There's the closing inventory, which is taken off the expense. But a bit like if we had accruals in there, an accrued expense there, the opening inventory is added to the expense. It's basically, it's been used up together. Right, here we go. Right now, prepayments. Our prepaid expenses, that's a debit in the balance sheet. Remember, that's an asset going forward into the next year. Our purchases, oh, we're very much messing this about between P&L account and balance sheet, aren't we? So that is going to be in our debit 128,964, and we've got a credit adjustment here. So remember the thing that I was saying before about our number line in here. So we take off the credit adjustment. So that will be what that figure will be here. It's just 28994 minus 2458. Okay, there's our purchases. Purchase ledger control account, okay, is our liability, and so that will be in our balance sheet, in our statement of financial position, and so we've got that as being a credit, but it's a liability to somebody else that's not a shareholder, and so that will be that. And again, we've got a debit adjustment, so we adjust for that. There we go. That's our purchase ledger control account credit figure. Our salaries are and expenses, so they go into the profit and loss account, or the statement of financial performance, whatever you want to call it. I prefer profit and loss account, but you seem to have a lot of messing around between various terms nowadays. Sales ledger control account, which is sales, haven't we? Let's not miss that. Oh no. Sales. So sales is amount due to goes to the profit and loss account. Amount due to shareholders, what they're going to get hold of. So they will have, that will be a credit. And then 443. There though. Sales ledger control account is an asset in the balance sheet, and so that's going to be an asset of 25775, and we've got a credit adjustment there, so of 399. Okay, so there's our sales ledger control account, and our suspense account. Let's see whether this clears. Let's see what happens here, because it would be in the balance sheet in there though. So we're starting off with a debit, and then we're going to have another debit, 2458, and we're going to deduct off our credit. Oh, it goes to 0. Yeah, that's okay, that's good. Might have been sneaky, might have left that as being a positive. And VAT is amount owing to HM Revenue and Customs, and so that will be a credit in the balance sheet, and so that'll be 8965 in there. Okay. Now then, what we now then need to do as well is we need to work out and add up our debits and credits in here. Because what you'll see now is if we do run this across here, see how it doesn't balance? So the thing that will not balance will be, so our debits are greater than our credits. Oh no. Sorry about that interruption, just had to go and answer the door. Right, so the difference in here, what we see is our balance sheet doesn't balance here yet. We've got this difference here, so we've got our profit and loss account. What we're going to have there though, let's see, we've got here, our debits are greater than our credits, so we've got a loss for the year. Loss for the year. So the difference between those two, where it should be there. Yeah. And hopefully now that's slightly different, isn't it? Which means what I've done there is somewhere along the line you can see that I've made a mistake, so something's missing. Let's just go back and check off our figures. Always make sure that it's nice and rock solid, don't we? Yeah, so we got our debit of 249. It's mainly because the figures are a bit small. There, and we got that in the right place. And 14,600 and the 10,000. Just go and have a look here. 14,962. Oh, we missed the adjustment off on that, didn't we? Alright, so let's have a look at what we've got here. We've got an adjustment here. So it'll be 14,962, and we're going to take that credit off there. So 14,932 minus 765. There we go. We're still up by 1, which means somewhere along the lines there's a small figure that I've not got right in here. Let's just keep going through and just checking it. I can't see that being right, really, but I can't see a number within there that's wrong, which is a bit annoying. I don't know. Let's go and let's actually grab the answer then. So let's just flip to the answer in the book. Give me a second. Here, 249. 1, 3, 6. Okay, saying that the income and expenditure is that. Purchases. Let's have a look at this one then. Purchases 994 minus 258. Okay, so there's our profit loss account and balance sheet adding up. Now, did you notice as well that you can see here where we had a mistake here, where it didn't balance correctly in as well as in this purchase line here, where I was out by 1, and also as well I missed off the adjustment in the general expenses there as well. Now by checking this and making sure that our trial balance balanced at the end of it there though, we could go back and check that. It took us an extra minute, didn't it, to sort of check through in there though, and we made sure that we got our answer correctly. Now this would be the thing where if you were doing this electronically and we're being drawn into putting a sort of snap set of figures in there without lining it out in a piece of paper, and checking it and doing your bottom line, adding up and doing the bottom line thing there though, you would have missed out those marks. I think that's the whole of it. So hopefully what we've seen going through is really a lot more about exam technique through that really. What we're sort of looking for as we're going through, how we've laid it out. So if we go back here, I've left out all of our workings as we're going through, what we would have seen on our piece of paper. Yeah, so we've got this really, which we would have had in our one piece of paper. We wouldn't have this bit in here, but we would have had all those laid out in our notes. Here, we didn't have the chart there, but we had that would have taken up another page or a couple of pages probably in there. And also as well, we had that on top as well. Here, task number 3, we had a fair bit of work as well again in terms of workings out. Task number 4, there's a lot of workings out, isn't there, for that one. And task number 5. In here, what have we got? Oh yeah, we had that nicely laid out. I would have also as well written out that as well there. So I mean, you can see I probably went through about 10 pieces of paper there, at least when I was in the exam, transferring it out, putting those numbers in there. A lot of use of tier counts and a lot of use of timelines, as you will have seen. The only time when I really did a table and did some calculations when I was in the extended trial balance. So that's that. I'm hoping that all the answers are right.